Now, the first session, I'm pleased to say, from your point of view, is not going to be chaired by me. It is going to be chaired by Hala Matar Choufany, who is President for the Middle East and Africa from HVS. So without further ado, I'm going to invite Hala to introduce her panel to you. Hala, the floor is yours.
Thank you. Well, thank you for your patience. I'm not sure if you can hear me. You can hear me? Yeah, that's great.
Can you hear?
Please allow me to welcome on this panel for a hard talk, Alain Debare, Group Head of Real Estate Portfolios, Equitativa Group.
I think you go in first. Go.
Thomas Jacob, Head of Strategy and Investor Relations from Mashreq. And Alejandro Martin, Senior Investment Banker, Abu Dhabi Commercial Bank. Well, this is a new technology for all of us, so I'm going to go here. Thank you. So hopefully you can hear us properly. And just to make sure, I can't see anyone, actually. It's very dim here. Just to make sure that everyone is focused and engaged after lunch for this hard talk, we're going to start off by 3 questions that you will need to vote and answer, and really to determine perception versus reality. That will be the theme of this discussion. We're obviously addressing the valuation in the market in 14 cities across the Middle East. We're going to be looking at what is happening, what has changed, and I can't wait to hear from all of you about transactions, about financing, about what is actually changing in this market. If everyone can go either on the AHIC app or on Slido, and if we could vote for the first question. So the instructions are, you go on AHIC app, you click on Ask a Question, and then you click on the link, the Slido link. And it should take you to a page where you can vote for what was the value per key for a 4-star entry, 5-star hotel in 2018. You've got a multiple choice there. Your best guess, just give it maybe 10 seconds before we close this question and move on to the next question.
I can't hear anything.
Oh, you can't hear me?
No, I can hear you because
you can hear you. Right, you're next to me.
Nothing. It's quite cool.
You can tell me what you think as panelists later.
On this one?
Since you're not on the app. So we can move on to the next question.
Oh, yeah.
Question number 2. Which city, in your opinion, had the highest value, average value per key in 2018? Again, 5 different multiple choice answers for you to pick one. I hope everyone is making a choice. Moving on to the last question.
Would you get a free study from HVS or something?
We're going to talk about the study from HVS. Yes, you will get a free copy. What's your outlook on the hotel opportunities and investments in the region? Aggressive, optimistic, negative, conservative, and cautious. If you can place your votes. And I think now everyone is ready to see the conclusion of the votes. I'm not controlling this. Are we getting them on the screen? Hopefully. So meanwhile, Alain, what do you think?
Oh, there it is. Yeah.
All right. So the majority, 36%, $250,000. Actually, I'm just looking around 20%. Think the value is around $350,000 a key. Alain, what would you have voted?
I'm quite happy with the 250.
Oh, you can't hear me, Alain.
Yeah, I can hear you.
What would you have voted?
I'd have voted the 250 also, yeah.
250.
Yep.
Super.
250.
Can we look at the next question?
Ah.
36% Mecca, 24% Dubai, and only 20, okay, still, no, 40%, almost 40% Mecca, 25 Dubai, and Beirut 7. And the last question, just testing a little bit the outlook of the participants. So the majority, yeah, a good 60% cautious, conservative, and negative, and 40% optimistic or positive. Well, that's great. I mean, just to set a little bit the stage of the discussion we're going to be having today, and I'm just going to take a couple of minutes to share with you the findings. If we can please have the presentation on the screen, and based on your responses and the findings with the HVI indicator for the 14 cities in the Middle East, and then obviously discuss what has happened. If I could have the presentation. Just a quick background, the HVI is an annual global indicator for HVS. For many, many years, we've been looking at value changes across US, Asia, Europe, and Africa. This year, we are pleased to share our first issue, the HVI indicator for the Middle East. It's definitely at this stage only 14 selected cities versus the 52 cities in which we track operating performance. It is based at the moment at 175,000 rooms, operating rooms in the market in the internationally branded segment, specifically in the 4-star and 5-star market. Again, just for this, for the benchmarking purposes, this is not including a destination hotel. And what I mean by destination hotel are those hotels that their value is primarily driven by non-rooms revenue. We have used 2015 as a base year to start this index. So we've obviously looked at changes in 16, 17, and 18. And we have assumed a 200-room hotel so we could compare across the cities. 2015 regional average was $373,000 per key for the 14 cities that we have studied. This is in line with some of you that thought the average in 2018 was 350. The bad news, however, is that the average since then, over the last 4 years, has actually dropped with a minus 5% decline between 2017 and 2018, and an average compounded annual growth decline of close to 18% between 2015 and 2018. As you can see from the chart, obviously, there are markets, including Ras Al Khaimah, Manama, Beirut, Jeddah, and Riyadh, that they have registered growth in values, whereas other markets, Dubai, Doha, Abu Dhabi, Medina, and Muscat had a decline in value. And really, the discussion today comes on the back of what we were hearing this morning about the declining trends in RevPAR and the opportunity to invest, and whether there is an opportunity actually to invest in the hospitality space. More importantly, what we would be looking at from a value change is we're not only measuring the top line, we are also measuring the profitability and the EBITDA. And I think this is more relevant to the bankers and more relevant to the buyers, is that what is the potential income? So one thing is RevPAR, but naturally, it is more importantly a discussion around the net operating income and the multipliers. Just quickly, if we look at 2018, if the average is 1, which is the $373,000 average for in 2015. In 2018, all 14 cities achieved 0.6. That means the value was 60% of the 373. That is $208,000 in 2018. We do forecast growth, and we can talk about that later, but that's not the really purpose of this. The full report is available at AHIC and on the website, but we are looking at values growing by 15% over the next 4 years, somewhere in 2022 at 0.8. So we are forecasting them to grow, but lower than the 2015 levels. This is what we're estimating could look like in 2022 assuming there is commitment from all the related parties, assuming everyone assumes the sense of responsibility, be it the operator, the investor, the consultant, and also government officials. So there is a recovery amongst all these markets. There are some markets, obviously, that declined sharply. So their growth in 2018 or 17 was massive. Again, I always say we need to look at a trend. It doesn't mean that a 60% growth in 2018 will repeat itself. A 60% growth came on the back of a minus 70% dip because of certain socio-political or economical challenges in these cities. Real quickly, just a summary of what has been said. 2015 values, 2018 values, and 2022 forecast, a decline of 18% and an anticipated growth close to 15% moving forward. Wow, okay, we're missing some graphs, some bars there. But the idea of this graph, again, is just to look as to how Middle Eastern cities compare to the globe, specifically as it relates, for instance, to Asia and Europe. You see the bar, the blue bar there is the Asia average, then Europe average, and this is where the Middle East average is. That's in 2017. The same chart for 2018, again comparing some of the cities such as Beirut, Medina, Kuwait City, Istanbul, to Frankfurt and the European average, just to put a bit more context around the discussion and the valuation exercise. And finally, I don't want to spend much more time on the slides, but based on what was said this morning, the presentation we've heard from Talal and the RevPAR changes, it's interesting also to see the changes in RevPAR in the last 4 years, which had an impact on changes in value. With that said, it's not necessarily the same relationship, because we will be bringing into our discussion now the basis of any valuation, which is the income stream, and how the RevPAR, but as well as the operating and GOP levels, have a bigger impact on the potential value of these assets. So with these slides, very interesting. Volatility, I guess it just mirrors any other economic indicator. It's cycles. There are upturns, downturns. We're probably now in a stagnation mode. I'll bring this to a conclusion, and I'll kickstart with my panelists. And if I can ask each one of you with one word to describe what we've just shared with you. Thomas?
One word, I'd go with optimistic.
Optimistic.
I think my word is the disconnect. Yeah, disconnect.
Disconnect.
Opportunity.
Opportunity, optimistic, and a disconnect. With the disconnect, I'd like to start this conversation. Alain, what has changed? Where is the disconnect?
I think the disconnect is mostly, the expectation, where the expectations of the owners were at the time they started their development, and based on which they've taken financial commitments, and where they are today. So obviously, the market has changed a lot. You had a landscape that was massively undersupplied. Everybody's coming to the space. In certain markets are starting to become oversupplied. And obviously, it's impacting performance, it's impacting the rates. I think all the operators are also looking at maintaining their market share. But even though they're looking at doing their best in maintaining their market share, it erodes the average room rate. As a result, when you compare the current performance to the projections that were done, 5, 6, 10 years ago, there's a huge disconnect at that point. And the expectations of the owners and the base on which they decided the investment at the time was based on those numbers.
Absolutely.
So us as investors today, we're finding it difficult to acquire properties at the right price. Obviously, we look at discounted cash flows, and when we come up with our numbers, lots of the current owners have surprised and say, I don't want to buy it, I don't want to sell that price.
I'll come back actually to talk a little bit more, because in your previous role you were building and developing, and now you're looking to buy assets. I'll come back to that, but you spoke about the market, whereas Alejandro, he described what he just saw up there as an opportunity. Where is the opportunity, Alejandro?
Well, so I work for Abu Dhabi Commercial Bank.
The challenge is I can't hear you well, so we need to speak a bit louder here.
Okay. I work for Abu Dhabi Commercial Bank, so we are on a commercial bank, and our business is to lend money for the right transactions, for the right deals. Can you hear me? No? Can you hear me?
I cannot.
Okay.
Right, I'll just have to.
So there is definitely opportunity for the bank to lend money for the right opportunities. The Abu Dhabi Commercial Bank has roughly 50% of the market share in Ras Al Khaimah for hotels, and we're keen to continue on this trend. But we are selectively choosing the partners that we're going to support going forward. So it is challenging, yes, it is. The right set of parameters have to be in place for us to provide the financing, but we are still keen on providing the financing because we see that there is an opportunity in Ras Al Khaimah specifically for hotels and to be developed.
Yeah. I think the challenge is obviously there may be the opportunity. I think what Alain touched on in my experience as well is that there is the opportunity, but there is also a disconnect.
Yep.
And how are we going to bridge
Yep.
expectation versus the actual?
Yep.
Thomas, you thought they were quite optimistic.
Yeah, I think I will touch on what Alain was also talking of and why I felt some of these numbers were a bit optimistic. I think the entire background is the supply overhang. I think that's the dynamic that Alain was also referring to. I think given that, I think the whole industry or market is really looking at this kind of supply coming online, and I think the challenge remains that will demand really catch up with that supply. So the entire supply demand will come into play, and which is why I think there's a bit of optimism needed that the demand would actually come in and catch up with the supply, because I think that entire supply overhang is going to be a key theme that needs to be addressed.
Yeah. No, absolutely. I mean, if we look at the additional number of rooms across all these major cities, there is a large number of rooms coming in. However, these rooms are expected to induce additional demand. I think the market still has good opportunities and is still set to grow, but we just need to make sure we are aligning. Alain, going back to the disconnect, I want to really understand, for the last 10 years, you have a track record of building a hotel portfolio and building hotels, and now you've moved on to buying hotels.
Yeah, so...
Different hats. How did your expectations change? How do you negotiate differently? What have you seen differently?
I think it's really being on both sides, right? But when you actually start developing a hotel, you make a plan, you look at your project costs, and you also look at your returns. So I think, as I mentioned earlier, the owners have invested on that basis, and I think that has set expectations. Some of the owners today, I think, are going through a tough journey, understanding and resetting expectations. Obviously, it doesn't happen overnight. I think it comes, it's stretching also the relationship, sometimes with the operators. Some understand less, but it's simple math. It's a supply and demand equation. You also have certain markets and certain authorities that have looked at the demand and supply and restricted the issuance of new properties. For example, Kuwait has got limited pipeline coming up, and there's a cartel that has fixed the rates, which ensures that the rates remain at a high level, and therefore the profitability of the hotels remains high. But you've got places like Abu Dhabi that stopped issuing hotel licenses till the market starts to recover. So I think it's as you mentioned earlier, it's really a balance of all the key stakeholders in the market to make sure we're able, if you continue to add new hotel rooms everywhere, the supply is outpacing the demand, obviously.
Did you see much of a difference between this disconnect being in the mid-scale or the focus and limited type of hotel versus the luxury and the upscale?
I think it's probably across all the segments.
Across all the segments.
It's really the price that an investor obviously have now moved on to Equitativa. So we're looking at acquiring hospitality assets in the hospitality REIT, and we've got a disconnect between what the properties are worth and what the people would like to see the transaction at.
So I'm prepared to share some numbers based on my observations. I mean, obviously, what I shared now is based on actual operating statements. That doesn't necessarily reflect every transaction, but we have been involved in a number of transactions in Dubai and elsewhere in the region. We have a good understanding of those limited and handful number of assets that transacted, what cap rates. Some of them sit outside of this range, obviously, again, as I said, because they are more of experienced destinations. But if I'd say to you that based on my experience in the last 10 years in this part of the world, the disconnect is close to 30% between the asking price and the actual price, or what, based on certain 10-year pro forma that you would be running, is saying. How does that 30% sound based on your experience? Is that exaggerated? Is that within range? Because I think we just need to, understand a little bit where is the market at the moment. Thomas?
Yeah. I think the 30% sounds like the right ballpark. And again, touching on what he was saying, the onus is really on the projections that we as a bank look at, right? As the owner or the sponsor, somehow the incentive is always to slightly inflate the projections, and we as a bank will have a slightly different estimate, when we do our formal valuations through third parties, and we then look at the projections that come in from the sponsor. I think that's where we also see a similar disconnect in that this 30% number sounds reasonable, and which is why I think as a bank we always do get into formal valuations as opposed to just the projections or valuations from the sponsor, because I think these independent valuations help us also for our internal discussions. So, and this is the disconnect that we also see.
And it's good you touch on this point, because again, I think one of the questions I had is really to understand, when you're looking to finance assets, what are the sort of criteria and what are the sort of sensitivities that you run on these assets. But just taking into the question on the 30%, I know, Alain, you have recently looked at a number of assets without specifying. Mm-hmm. What was your experience like based on what you were prepared to pay versus what was being asked on the market?
Again, about that 30-35% range.
30 to 35%.
That's what we found.
Alejandro, do you want to disagree?
No, I don't disagree. There has been quite recently one transaction that has been in the market. A sponsor ended up acquiring 4 hotels. There was a consensus, or there was some sort of like a number that the market was willing to pay, and the investor that ended up acquiring the business paid a bit more. From a valuation point of view, we ourselves, as Mashreq was explaining, we run our own valuations. So we have the numbers that the client, the operator, or the owner gives us as the base case, what we call. We do our own. We have third-party analysis, like yourselves, Cavendish, CBRE, and the likes, and we have our own independent in-house analysis of how much the value of the property that we are considering financing, building, is worth, and how much debt this specific asset can sustain on a long-term basis, because the reality is we don't want to provide financing and 3 years down the line, when the property is ready to be opened and start generating cash, they hit a wall because the amount of debt that they've incurred is just too high. So that is also quite relevant on the long term. Right. Just making sure that the parameters stack up and the capital structure is the correct one. The right amount of debt, the right amount of equity, the right amount of incentive for the operator. The operator usually wants to be at the head of a chain with regards to payments, and then leave the rest for the rest of us to live with. That also has to be managed appropriately.
You're touching on my next question, but I'm having a lot of difficulties hearing you, Alejandro. If you don't mind, Thomas, can we swap so I can hear him closer?
Yeah.
If that's all right. Yeah, super. I think I heard you saying something about the operator, so that brings me into my next question is, when you're looking at an existing or a proposed asset, how important is the brand strength, when you evaluate these financing opportunities? I'd like to hear from all of you, but we'll continue with you, Alejandro.
Well, the brand is, it's not just the only thing that we look into. It's a combination of factors. But obviously the brand in itself has its own merits. The Rixos, Accors, Ibis are in one set of basically sort of like a target area. Then you have the 4 stars, then you have the 5 stars, they have the ultra luxury brand like Madinat Jumeirah. So the brand itself has a value in itself, which has to be taken into consideration. With the value, with the brand itself comes also a price, because you have, well, so those investors, those properties demand a higher valuation because of the fact that they will have to invest more money to bring in the property to a certain standard, which is, for example, for a 3-star hotel, it won't be the case. So you have a bit of a disconnect there with regards to how much debt and equity they'll have to invest.
Yeah, how that's all playing up. Alain, what's your thoughts on the importance of the brand in creating the value?
I think it's very important. Today it adds a lot of credibility, I think, to any project or to any hotel we look at. Because you will know that your hotel will be built to certain standards, and when they're managed, they're usually well managed. And again, so you've got versus an independent hotel where you don't really know what you're going to get. So there are great independent boutique hotels here and there, but the day you sign up and you do a hotel with Accor or AHG, you know what you're going to get. So and the bandwidth is clear. Now, whether it's managed or franchise is another discussion, but I think the brand's an important.
I mean, I think if you're looking at acquiring an existing asset, it becomes even more relevant because there's some history around how the brand is delivering in that asset.
Yeah.
The question is perhaps more critical, and this is where we're seeing I would call it a correction rather than a devaluation. Although there is a decline, in my opinion, there is more of a correction of these values that were quite aggressive back then. I think what I want to understand is, are the operators at the moment driving value to an asset? Because it's important when we go and secure finance, the operator obviously carries a certain premium, and the banks are comfortable that it will be finished and operated to a certain standard, yet the valuation is based on income. And I know I'm going to be hated by the operators, but I have to ask this question and to try to understand, where is the disconnect?
What I would say is, perhaps, I'm not sure if they do bring in the value. What they do bring is the certainty. Some brands, Jumeirah's, Atlantis, Riva, they give you the comfort that there is going to be a stable stream of cash flow coming in year after year, and on the back of that you can back solve of how much debt you can put in, how much you can leverage up the business to and sustain the story going forwards. I am not sure if they do, if it's only because of them that you have the steadiness of the cash flows, or if it's because of the location or because of the proposition that they are basically bringing into the market. But what they do bring, for sure, some of these names, is the visibility and basically the floor where you can bank on that floor.
Yeah.
So
let me just add to what you're saying. And I think that is really the key, right? I think what you're saying, as a bank, the financial projections are important, right? Because for us, it is about cash flows. And what I think a good operator gives is that comfort level, that these projections have a higher probability of being met, which is what a bank is really looking for. And that's, I think, where really the comfort level comes in from a bank. That, okay, yes, this is a known brand. There is a higher probability that these financial projections are more realistic and more attainable in that sense.
Right.
So.
I mean, again, I'm not trying to point fingers at anyone. I think personally there is a number of reasons for that. There is an overspending by the investor. And oftentimes this is where the challenge we have seen is that they are comparing the actual value to the development cost. And that's not necessarily how we are computing the actual value, or a potential buyer may look at it, because all they're doing is they're looking at the income stream.
Mm-hmm.
There is an element of responsibility on the consultants who are doing these feasibility studies and advising the way they're advising. There is a responsibility on the operator to perform according to a certain budget. And perhaps there is a responsibility also from a financing standpoint, because if I hear you correct, you're running your own sensitivities, and based on that, you're lending. These development costs are many times way higher than what the actual potential income is, and therefore there is a default on the debt servicing.
Mm-hmm.
And these situations are arising most of the time, especially in the current conditions. I guess my question is, how much are you willing to discount, or how far do you go with discounting how much you're prepared to lend?
Well, so you have, in the past, if I can start from the last part of the question, in the past, what we were doing is a fully amortizing facility, for example. So you give, I don't know, 100 million dirhams worth of debt, and over for say 10 years, and this 100 million gets fully repaid in 10 years. So that was then, I would say, probably 2 or 3 years ago. That was the story, basically a fully amortizing facility. Lately, because of the valuations have gone up and because we have to provide for more debt to support part of the equity that is not coming, the reality is, due to the fact that not only the RevPARs and the occupancy and the ADRs have been compressed, and we have to put in more debt, the reality is there ain't much cash to pay down. So there's a bit of a bullet. The concept of the bullet is basically kicking in more and more. And the bullet not only is now sort of like a de facto statement that you have to have a bullet, but also the size of the bullet is going higher and higher and higher for longer and longer and longer. So the way to provide for this is to have, at the end of the day, the cash flows are what they are, and they're only going to be able to generate that much cash, which is going to bring in the debt. So if you're left with something else, either you have to pick it or you have to push it down the line if the project itself is worthwhile doing.
Okay.
Yeah.
So, yeah.
Let me just try to also quantify that, Hala. So I think let me give you a ballpark figure. I think a 60 to 70% LTV is what banks are normally comfortable with, right? So that's already kind of factoring in a haircut to the overall valuation. Now the 60 to 70, I'm giving it as a very broad range. This could again vary depending on a lot of factors, right? It could depend on the type of property being financed. So maybe if it's a 5-star hotel, maybe it's on the lower end of the LTV. Whereas if it's a hotel apartment, you might push the LTV up slightly higher. But the whole concept of this LTV, in one sense, does factor in that we're not going to probably be giving you 100% finance on the value anyway, right? So
I think that's also where the gap is. Because certain banks would look at LTV, and us as investors will look at cash flows, right?
Yep.
Yep.
So when you come to me and you show me evaluation, honestly, that paper we hardly look at it. We'll do our own projections, we'll do our sensitivities. I know you do the same, we're banking together. We look purely at the discounted cash flows, and we look at anything above 55% LTV for us is something to pretty much keep off.
The issue sometimes, if you push, going back to what I was saying at the beginning, if you push the LTV, if you push the amount of debt that you take on day one, perhaps you can get away with it. I'm not saying that you won't. But at some point, if you don't have sufficient cash to pay it off, then you're going to be hitting a problem. So, and it won't be good for the operator, to the owner, and it won't be good for us as well, because at the end of the day, we don't want to end up running a hotel. We must as well go to the next one and the next one. But yeah, so it's critical to understand the serviceability of the debt and the realistic assumptions that go into how much the hotel is going to be worth.
No, definitely. I mean, we've observed these challenges. On that one specifically, I'd like to understand a little bit more. When you're doing your own numbers and you're looking at an opportunity, how do you consider the land costs? Because this is, I think, what we were trying to get at here. The 100%, is it on the development cost with the land being 30%? So, are you lending up to the total development cost?
Well, it gets better. Sometimes even the land has been gifted. So it's
but they won't record it accordingly, right?
So ideally, it's hard cash. That's equity.
Right.
That's
what's going in.
Yeah. So the actual pennies, bit by bit, that's what we call equity. More often than not, we have to consider cash in kind, land, subordinated debt, grants, as part of the equity contribution from the owner or the sponsors, which also might be deferred over time, so increasing the IRR. So it doesn't come in from the very first day. So there are occasions where we have to also basically go pro rata together, equity and debt. Ideally, equity should go in first, and then only debt comes in. But obviously, that kills the IRR that equity is going to get. So we have to come in together. So there are a number of things that you can play with and accommodate. So for each and every transaction is different. Every sponsor is different as well.
Yeah. Absolutely.
And I think the problem is not considering land as equity. right? I mean, it can be considered, but if that is considered as the only equity, I think that's when the problem comes in, right? I mean, it can be considered quasi, but we do need to see some more skin in the game. We need to see actual cash as commitment from the sponsor. Only then do we really feel that they've got a stake in it. So.
Okay. I mean, at the moment, obviously, everyone is asking, are you financing? Within the current circumstances, are you financing? My understanding is that it is still happening, but I'd like to hear from you. Are you doing more financing or refinancing? How attractive is the industry? Yeah. Go ahead, Thomas.
No, I think the answer is a solid yes. If I just give you a little bit of historical data to put it in context also, if you look at lending to commercial properties and especially the hospitality sector, central bank data showed massive growth in 2016, almost 30% growth, lending growth. 2017, slightly down to 25%. 2018 numbers are not yet out, but you're probably seeing growth still. So there is very much a lending appetite to this segment, which is one of the better performing segments. And I think the other important thing to mention is the fact that the real estate cap, which is originally placed by the central bank on banks, has now been relaxed. There used to be a 20% cap that the overall loan portfolio of a bank cannot exceed 20% exposure from a real estate perspective. That cap has been temporarily disbanded. So that does give much more headroom for the banks to lend in the space.
Okay. Alejandro?
ADCB has been quite aggressive in Ras Al Khaimah, so we own roughly 50% of the hotels. Basically, we are financing one way or the other. In RAK, in Dubai, it's pretty much, I would say, some were similar, not as aggressive as RAK perhaps. In Abu Dhabi, the bank is quite aggressive. That is before the merger. Once the merger is complete, our balance sheet is only going to get stronger. So I think it's safe to assume if we have acted in one way before the merger, the fact that we are a stronger bank would only encourage us to, with the same sort of parameters and analysis and assumptions that we take to continue going forward. We're doing it in Abu Dhabi with yourselves. So it's on a case, the case itself has to stand its own merits. Right. So it's not a clean check to everyone. But if the case is worthwhile pursuing, the bank has a business as usual kind of approach.
That's positive. I'm sure that will be well appreciated. Just before I open it, obviously, to the audience, one last question to Alain. You're looking, obviously, to grow the hospitality portfolio.
Absolutely. We're looking at opportunities. We recently put a bid on the portfolio that was out there, from which we pulled out from the moment the expectations became totally unreasonable. Mm-hmm. So we left it to somebody else.
We're all nodding. Obviously, looks like we've always all been involved. We're all nodding here, okay?
And so we're obviously looking for the right opportunity at the right time. The hospitality REIT is non-geographically limited, so our first transaction needs to be a portfolio, needs to be 4, 5, 6 hotels. Why not 10, 12? So it's funded, so it's something on which we're quite capable of moving fast.
Okay, and you said it wouldn't be only necessarily regionally. So it is the right opportunity, or is it only regionally?
No, it's the right opportunity. It's non-geographically restricted.
Okay.
So I think to start a REIT, hospitality REIT, you need to have a certain size, 5, 6, 7 hotels. And then it will go, acquiring hotels one by one. There's lots of opportunities out there one by one, but the issue is more...
That's what I wanted to hear from you. Is there opportunities, and are there good opportunities? Now, I understand that the portfolio may restrict you, but just as you are observing the market, and you've been observing the market for a very long time, are there good opportunities?
Yeah, there are opportunities in the hotel space and outside the hotel space. Our investment team over the last 18 months has reviewed a bit more than 1,000 properties. So there are lots of opportunities out there. There's good and bad. It's about finding the right one at the right price.
Okay. I mean, and oftentimes, when we talk about hotel valuation, we always run with, a real estate valuation. And what we try to explain is that the hospitality valuation is based on an income stream.
Yep.
The question to you, all of you, is how much is a hospitality asset different to a real estate and, say, the residential market in particular, when you're looking at investing in this sector?
And you still look at, depending on how you look at your, from commercial real estate is on discounted cash flows also. So your cap rates might be slightly different. Our residential is on comparable per square meter, per square feet. So Depends on the sector.
It's always perceived to be a safer investment, right?
Hotel?
I mean, I'm not making an assumption here. I'm asking you.
Yeah.
That's what it has been perceived, although we see today that the real estate market is perhaps even more challenged
Yeah.
than the hospitality market. Hence why I would like to conclude with this question before we open it to the audience.
Well, yeah. So the real estate can go down as it has been going down year after year, month after month, and on the value on the actual value. Whereas on the hotel, at least you have, if the asset itself, the value of the asset is coming down, at least you have the income, the income coming in on a monthly basis or on a daily basis, which somehow helps navigate through the crisis. So it's potentially a bit better, but yeah, they're both equally challenging.
For me, it's not a clear-cut answer. I think there's a kind of plus or minus to this, right? On the plus side, I think let's be cognizant that this is one of the best occupancy rates globally. I think that's a definite plus when you look at the asset. But on the negative side, I think let's also be cognizant that the operational effort needed for this hospitality asset is, I would say, much more difficult than a retail or a commercial
absolutely.
building in that sense, right? So I think that's
and
why
it's understanding those key differences
Exactly,
that
so,
really
yeah.
has a big impact on your operation,
That-
especially when you factor in seasonality and changing trends, etc. It becomes even more complex,
Yep.
and hence why we say that hospitality valuations are way more complex than any other real estate, and not to be confused between the two. And again, the argument about you can spend as much as you want to build it, but once it's built, it is valued based on an income stream.
Yep.
So that income stream is going to determine the value, and it's not your development cost that will determine the value. I'm not sure how we're doing on timing, but I'd like to open it for a few questions. Jennifer, do you give us 5 minutes? I can't. No?
Right. I think we have
one
one
question.
I
question.
couldn't.
one question.
That's probably one question.
Yeah.
You said okay. Any questions?
Wow. Now I can see.
Let's see who's there.
Perhaps we don't have any questions. No,
That's
I can't
good.
see, but I'm assuming that's it. Okay. Well, thank you very much.
Thank you.
Thank you.
That was actually quite interesting. Thank you.
Thank you.